Hello. In this video, you'll learn about analyzing business transactions using T accounts. In prior videos, we learned to analyze business transactions using the accounting equation assets equals liabilities plus owner's equity. And we recorded the 12 initial transactions for Eli's Consulting by entering the amounts in the accounting equation table. However, recording transactions in an equation format might work when the business has very few transactions and only has a limited number of accounts. But imagine how difficult it would be if the business had a lot of transactions over many years and different accountants would have to share the same ledger book. Also, the business might not really want all accounts to have access to all transactions. So an alternative to recording transactions in the equation format is the use of the T account. The T account is an important visual tool used as an alternative to the fundamental accounting equation format. Just like it sounds, T accounts look like a T with the name of the account above the horizontal line. The left side is called the debit side, and the right side is called the credit side. Assets increase with a debit on the left side. Liabilities and owner's equity increase with a credit on the right side. Here's a visual of assets, liabilities, and owner's equity accounts and how they increase and decrease. Assets increase with debits on the left side and decrease with credits on the right side. Liabilities and owner's equity accounts increase with credits on the right side and decrease with debits on the left side. So let's walk through the 12 business transactions for Eli's Consulting and analyze them by using T accounts. In the first transaction, Trayton Eli gave $100,000 from his personal funds to the business. When we analyzed this transaction using the accounting equation in Chapter 2, we said that the business's cash, which is a property or asset of the business, increased, and that the owner's equity also increased by $100,000. So how do we write this transaction using T accounts? Well, cash is an asset account, and we learned that assets increase with debits. That is why we write a debit on the left side of the cash account. The amount the business owes to the owner also increased. We learned that owner's equity accounts increase with credits on the right side of the T account. So let's write $100,000 credit into the into the owner's equity T account. Remember that all transactions must always balance. Otherwise, our accounting equation would not hold true. With this first transaction behind us, let's look at the next transactions. In the second transaction, Eli's Consulting Services issued a $5,000 check to purchase a computer and other equipment. So our computer and other equipment increased by $5,000. And at the same time, Eli's Consulting issued a check, which means that cash decreased. Both of these accounts are asset account. One increases and one decreases. The equipment account increases. That means that we increase the account on the left side with a debit of $5,000. Cash decreased. Cash is an asset. Assets decrease with credits on the right side. So we'll write $5,000 onto the right side. For the third transaction, Eli's Consulting Services purchased office equipment on account from Office Plus for $6,000. Our equipment, which is an asset, increased, so $6,000 debit on the left side. Our accounts payable also increased. Accounts payable is a liability account, and liability accounts increase with credits. Therefore, we'll write $6,000 credit on the right side. For our fourth transaction, Sanchez purchased supplies so that Eli's consulting services could start operations. And for this transaction, Eli's Consulting issued a check for $1,500 to Office Deluxe Inc. to purchase office supplies. Office supplies increased. Office supplies is an asset, and assets increase on the left side with a debit. So we'll debit the account office supplies for $1,500. The second part of our transaction must therefore be a credit because all transactions must balance, and our first transaction was a debit. All right, so we already know that we'll need a credit to an account. We issued a check, so cash decreased, and therefore we're going to credit cash for $1,500. For our fifth transaction, we're going to report the transaction where Sanchez, the office manager, decided to reduce the firm's debt to Office Plus by $2,500. We had previously purchased equipment from Office Plus for $6,000, and we're now reducing that debt by $2,500. That means that our accounts payable are going to decrease. Remember, accounts payable is a liability, and liabilities increase on the credit side and decrease on the debit side. So we're going to debit accounts payable for $2,500 and now reduce the accounts payable. We also decreased our cash account, and cash is an asset account and decreases with credits. Therefore, we're going to credit cash by $2,500. The sixth transaction, Eli's Consulting Services issued a check for $8,000 to pay rent for the months of December and January. Payments in advance for rent are considered prepaid expenses and are considered an asset of the company. So we need to debit prepaid rent because our asset prepaid rent increases and assets increase with debits. And again, just like we had in prior transaction when Eli's Consulting issued a check, we need to decrease our cash account with a credit for $8,000. We've now recorded all of the transactions for November, and we can calculate the account balances for all of the T accounts that currently have transactions. So how exactly would we do that? Well, we would add the figures on each side of the account and enter the sum in a small pencil figures called a footing. In practice, this is not really done anymore because typically most businesses use software programs and the system will do that for you automatically. But it's good to practice the theory, okay? Subtract the smaller total from the larger total, and the result is the account balance. The total is recorded on the side with a larger amount. And usually, account balance appear on the increase side of the account. What that means is that, for instance, for assets increase with debits, so typically that's where the balance would be. And it's also called the normal balance. Now let's take a look at the cash account. We had an increase in cash from the investment by Trade and Eli of $100,000, and then four transactions that decreased the cash account for a total of $17,000. So that's called the footing, $17,000. And then we'll calculate the balance, which is $100,000 minus the 4 transactions that decrease the cash account for $17,000, leaving us a balance of $83,000. We do the same for the other asset accounts, and you can see supplies has a balance of 1,500. We don't even need to calculate anything because there's only one transaction. Same thing is true for prepaid rent. We can see that the balance is $8,000. For equipment, we had two transactions, so we'll calculate the balance by adding those two transactions. And we'll do the same for the liabilities. We had increases in liabilities of 6,000 and a decrease of 2,500, leaving us with a balance of 3,500. And we have the investment by Trayton Eli as an increase to the owner's equity account. Once we have all of this, we can prepare the balance sheet. We don't have any other financial statements that we're going to prepare at this point because no other transactions impacted any of the other financial statements. All right. So balance sheet header, as we previously discussed for chapter 2, the name of the business, the name of the financial statement, and the time period. On the left side, we have the assets, listing out the cash, supplies, prepaid rent, and equipment. All assets total $103,500. On the liability side, we have accounts payable of $3,500 and owner's equity of $100,000. Also, the liabilities and owner's equity total $103,500, which confirms that our accounting equation still holds true. Assets equals total liabilities and owner's equity. We're now ready for the next 6 transactions, starting with the 7th transaction, where the business earned $36,000 in revenue from clients who paid cash for bookkeeping, accounting, and consulting services. So it looks like our cash increased by $36,000. Cash is an asset. Assets increase with debits, and therefore we're going to debit cash for $36,000. Our revenue increased as well. Here specifically, we're using the account fees income. Fees income is part of owner's equity, and owner's equity increases with credits. Therefore, fees income increases with a credit of $36,000. For our 8th transaction, Eli's Consulting Services earned $11,000 from various charge account clients. So in contrast to the prior transaction, we're not receiving cash, but we're receiving something almost as good as cash. Still an asset, and it's called accounts receivable. Accounts receivable is an asset, increases with a debit, and therefore we're going to debit accounts receivable for $11,000 on the left side. Fees income increases just like the last transaction, and fees income increases with a credit of $11,000. For our 9th transaction, the company received $6,000 on account from clients who owed money. Basically, those clients right here, where we have an accounts receivable of $11,000, they paid us. So they're going to pay down the accounts receivable, and they're going to give us cash. In order to reduce the accounts receivable, we would have to decrease it with a credit of $6,000, and our cash increased. Cash increases because it's an asset with a debit. So $6,000 debit to cash and a credit to accounts receivable for $6,000. In our 10th transaction, Eli's Consulting is paying $8,000 for salaries. Salaries expense is part of owner's equity, and salaries expenses increase and decrease owner's equity. Therefore, we need to debit salaries expenses. So just keep in mind all expenses increase with debits. So easy to remember probably. And revenue always increase with credits. So salaries expenses are debited for $8,000, and we're paying it with cash, and our cash decreases. Therefore, we credit cash for $8,000. Here we're paying utility expenses for $650. It's pretty much identical to this transaction, except that we're using a different expense account. But the concept is exactly the same. Debit utility expense for $650, credit cash for $650. For our 12th transaction, though, this is not an expense because Trayton Eli is essentially just taking some of his investment back out of the company. So the company owes him less money. Withdrawals are funds taken from the business by the owner for personal use. So let's analyze this transaction. Our cash decreases, so we know that's a credit to cash of $5,000. So we're looking for the debit, and for that we're actually using a separate account called Trayton Eli Drawing. It's part of owner's equity, but drawing amounts are tracked separately to have a better overview of how much was taken out for personal expenses. Okay? So debit to Trayton Eli Drawing, $5,000 debit on the left side, and our cash decreased, and that decreases with a credit on the right side. We again tally up all of our T accounts on the asset side, right here, our liabilities, and then owner's equity, which also includes fees, income, and expenses. Right? Once we have done all of that, we can move on to looking at our trial balance. What's a trial balance and why do we prepare a trial balance? What's a quick overview of our account balances, our T accounts into which we've recorded our business transactions. The trial balance is a statement that tests the accuracy of total debits and credits after transactions have been recorded. In practice, you would run a report that is called trial balance in your accounting software program. If total debits do not equal total credits, which happens all the time, not in an accounting system, because that is checked automatically. You wouldn't actually be able to record a transaction that doesn't balance. But as we're practicing accounting, it will happen to you all the time. So there are a few tips for finding what transaction you might have recorded incorrectly. If the difference between debits and credits can be divided by 9, there's a transposition error, like for instance 45 or 54. Okay, that's the difference between your debits and your credits, or any other amount divisible by 9. That means that you've transposed something, meaning, for instance, you entered 3,500 on one side and 5,300 on the other side. That would be a transposition error. A slide occurs when the decimal point is misplaced. So you've entered one side as 375 and the other one as 3750. Okay, those are the two typical errors that you might find. Other errors would be you recorded a debit, but you forgot to record the credit. That's typical as well. After the trial balance has been prepared and we double check that the debits equal the credits, we're now ready to prepare the financial statement. So don't forget that important step. Double check that your debits equal your credits. Okay. So what do we prepare first? It's always the income statement that comes first. Why? As a reminder, you need the net income from the income statement to complete the owner's equity, right? You can't prepare the statement of owner's equity if you don't have the net income. And you can't complete the balance sheet without knowing the ending balance for the statement. Okay, so it's important that you have that. So let's start with the income statement. We go back to our trial balance. We enter the fees income from our trial balance. We enter the expenses. We subtract the expenses from the revenue and come up with the net income. Okay. We next prepare our statement of owner's equity, which requires us to start with the beginning balance of the capital as of December 1st of $100,000. We add to that our net income of $38,350 from the income statement. We subtract what Trayton Eli already took out, basically either a payback of his initial investment or essentially taking some of the profits that the business generated. We combine net income less the withdrawals and then add that amount to the beginning balance, coming up with an ending capital balance of $133,350. We're now ready to prepare the balance sheet. We first list out all of our assets: cash, accounts receivable, supplies, prepaid rent, equipment, for a total of $136,850. And we list our liabilities on the right side, starting with accounts payable, $3,500. We then list owner's equity, another form of liability that the business has, and we enter the Trayton Eli ending capital balance of $133,350, which we got from the statement of owner's equity, for a total of $136,850. And we again see that our accounting equation of assets equals liabilities and owner's equity still holds true: $136,850 on one side and $136,850 on the other side. I hope this was helpful. Keep practicing and don't hesitate to reach out if you have any questions.